Hello, this is Brad Harvey with Harvey Investment Management. Thank you for tuning in to Investing 101, Part 2. Part 2 is how to implement your investing strategy. Now, I'd like to recap a couple of concepts from Part 1 to make sure that we're all on the same page. Remember that we're here to protect and grow wealth. That is our primary function. And there are two phases of investing: accumulation and access, also known as growth and income. Another important concept that we have to keep in mind is the old strategy or the old cliche of buy low and sell high. Now, we want to take the emotion out of that as much as possible, and it can be extremely difficult because when things are low, people tend to think they're going much lower, so they are very fearful. And when things are high, they think they're going much higher, therefore they can be very greedy. Okay, keep in mind, Warren Buffett once said, and I think pretty eloquently, when everyone else gets fearful, I get greedy. And when everybody else gets greedy, I get fearful. And he's been a very successful investor over time. The next important concept to keep in mind is the law of supply and demand. Now, I would tell you that I think this is the most important law of the universe. Certainly the physicists out there would disagree with me, but I think the law of supply and demand comes into play with investing all the time. Because if things are scarce, prices go up. If things are plentiful, prices go down. But the reverse is also true. If we have decreasing demand for something, prices tend to go down as well. And if we have increasing demand for something, prices tend to go up. So we had a recent example of the COVID-19 virus and the pandemic that subsequently followed. And all of a sudden we had scarcity of certain goods in the stores. We had scarcity of the personal protective equipment for hospitals and masks and gloves and things of that nature. And so it took a little bit of time for the supply chains to gear up on the production side to stabilize the prices so that they could meet that demand. But in the interim, price gouging did occur. So people that had lots of hand sanitizer, for example, they were out there increasing their prices dramatically to try to take advantage of the supply-demand imbalance. That supply and demand imbalance happens all the time. If you're the only company making something and you have a monopoly, okay, you better not price yourself out of the market, or other people are going to come in to provide that supply and capture those revenues. So that's supply and demand in a nutshell. So as we move on to implementing your investment strategy, remember there are lots and lots of different ways to do that. I'm just going to talk about some very simple ways to do it. The first step would be to actually open an investment account or a brokerage account. Once the account is open, then you fund it, you can write a check for deposit, then you're ready to actually invest. Investing is the transaction piece of the business. So once we have the account set up, then we have to put together our investment plan. How do we want to buy and what exposure do we want to get our asset allocation together? Remember, your asset allocation is simply the percentage of your investments that are in different asset classes. And you'll remember from Part 1, we talked about stocks, bonds, we talked about real estate, we talked about commodities. Those are the assets that are going to feed into your asset allocation. And then how we actually get exposure to those, we talked about mutual funds. And now I'd like to also talk about exchange-traded funds. Exchange-traded funds, which are frequently referred to as ETFs, that's the acronym for that, obviously. They are index tracking stocks that can track bonds, commodities, stocks, all kinds of different sectors. It can be a very tax efficient and very inexpensive way to get investment exposure for your asset allocation. Now remember, we have those different asset classes, so we want to make sure we have some basic assumptions. Okay, so these are the performance expectations. So when we look at stocks, for example, we are going to assume a rate of return over time of about 10%. 10% is on average going to work for us for the longer term. So if we have 100% of our asset allocation in stocks, then we can expect a 10% rate of return over 100 years per year. If we put 100% in bonds, I think a 4% rate of return is a reasonable expectation. Real estate, we can reasonably expect 6% per year. Commodities tend to match inflation, so let's say that's 3% per year, and inflation at 3% per year. So an asset allocation might look something like, I want 65% exposure in stocks, and I want 30% exposure in bonds, and I want 5% exposure in commodities. And then we're going to reevaluate this on a periodic basis and maybe rebalance. So if stocks have had a great year, perhaps we would be selling some of our stock exposure and buying into commodities that might have had a difficult year. That's part of the portfolio management process, or rebalancing things over time. So as we go back to that asset allocation mix, I think it's important to maintain that on an annual basis at least. Keep looking at it and making sure it is what you want. And if we have a major event, bonds, for example, interest rates go up super high, or stocks have a really tough quarter or a tough year, they're down 20% or 30%, maybe we want to trigger a rebalance that's off cycle. That's part of the portfolio management that comes in over time. Now you can also drill down even further and say, okay, do I not just want stock exposure for 65% of my allocation? Maybe I want some non-US exposure. I want international. So maybe we're going to take 10% and put it in non-US companies, and 55% would be in the US. And maybe we want to drill down a step further and say, you know, I want small and medium-sized companies, or small cap for capitalization, or mid cap for capitalization, or large cap. And I want to mix that up a little bit to try to diversify further. Most people just look at the S&P 500, which is the Standard & Poor's 500 index. That's 500 companies that are based in the United States that the Standard & Poor's Media Company has selected as most representative of what's going on in the US economy. But those aren't all the stocks that are out there. So maybe we want a total market index. You just want to become educated on how this works when you're putting together that recipe, or find someone that you trust that can help you to put that together as well. On the bond side, you have the same basic decisions. Do you want taxable? Do you want tax-free? Do you want high yield, which is also known as junk bonds? Those are bonds that are issued by corporations that don't have the same credit rating as large, very healthy corporations like Coca-Cola, very high credit rating. You can have corporate, you can have government. If you're going to go tax-free, then there are municipal bonds. Are they issued by the state, by the county, by the city, by the utilities? Lots and lots of different options there. Commodities. Do we want broad-based commodity exposure? Do we want precious metals in particular, or industrial metals? Or do we want energy? So there are lots of decisions that can drive toward that recipe or that asset mix that's going to be part of our asset allocation. And you'll remember from part 1, we talked about the hook chart, which is your level of risk and expected returns. As you're putting that together, remember the hook chart just talked about 2 asset classes, but by way of reminder, your lowest risk portfolio over time is actually 20% in stocks and 80% in bonds, where intuitively you'd think it would be 100% in bonds. So keep in mind, when you're managing your asset allocation, risk is an important part of this. It's not just returns. You need to take a look at that. So as we're putting together our asset allocation and we're deciding exactly where we want to put our money, 65% in stocks is the example that we are using. We also want to be mindful of diversification or correlation. These are 2 definitions that are very similar and very, very important. Correlation is the degree to which asset classes or investments tend to move together. For example, if you own Intel and AMD, those are both semiconductor manufacturing companies. So they tend to move together. They have a very high correlation. Okay, we would call that mostly a perfect correlation, or a 1 or 100%. But there are other things that we can buy that are still stocks that are not correlated to the same degree. And when you move to another type of stock or a different sector, then that is called diversification. So if we diversify and we say, all right, we want to own 2 different companies that don't necessarily move together. Normally, if we did that, we lower our risk overall. So what is an example of that? Well, the traditional example is airline companies and oil companies. Airline companies, one of their largest expense every year is fuel. So the more fuel they use, the more it costs them to operate if that fuel costs more per gallon. Where oil companies, the more things cost per gallon, or the more they can sell them for, the more money they make. So the higher the cost per gallon, or the price per gallon for Exxon, for example, the more money they make. But the higher cost per gallon that they sell it for, the less money United Airlines might make. So that's a way to change your correlation, reduce your correlation, or diversify a portfolio. A more traditional way to do that would be our hook chart example, where you're saying, okay, I'm going to put 60% of my money in stocks and I'm going to put 40% of my money in bonds. Therefore, I have diversified my overall exposure. So if interest rates go up, then my bonds might get hurt, but my stocks might do okay. So they are diversified. Unfortunately, when we have times of great stress in the investment landscape, correlations tend to all get more positive. They go closer to 1. So things tend to all sell off at the same time. So diversification helps and it works. However, there are certainly times when it is more effective than others. So keep that in mind as you're putting together your asset allocation. You can also over-diversify things. So if you're trying to put together a portfolio and you say, okay, I just want to own 1/10 of everything. So I want 10 different stock indexes. Well, you really end up with a lot of overlap and you don't get a lot of benefit, although you might drive yourself a little nutty trying to keep track of more asset classes. Okay, so diversification can be your friend, it can be your foe. Correlation can also be your friend or your foe. Just be mindful of those concepts. Okay, so another example as we're talking about correlation or diversification, if we're trying to hedge against inflation, we're trying to make sure our portfolio keeps pace with inflation or does better. Well, the asset class that follows inflation the closest is commodities. Why? Because, well, that's stuff that we're consuming. That's the stuff coming out of the ground. But if we just said, all right, I just want commodities, I'm going to put 5% of my portfolio in commodities so that I hedge against inflation. Well, that works great, but what if we go into a minor deflationary cycle? Well, those commodities are going to get hurt because they're highly correlated to inflation. Or put another way, there is no diversification between inflation and commodities over time. So after we've put together our asset allocation and we know our performance expectations, so we have our different asset classes and the expected returns that go into our mix, now we have a benchmark that we can use to track whether or not we are on pace to meet those goals. The most common goal that we talk about is retirement. What is retirement? Retirement is the point in time when you no longer have to work for a paycheck. You can be 40, 50, 80, it doesn't really matter how old you are. It just means that you have enough wealth accumulated so that when you start to access that wealth, you start to get income from that wealth, that it offsets your cost of living. So you no longer have to go out and work for a paycheck. In my opinion, retirement doesn't mean that you stop working. It just means you no longer have to work. So this is Brad Harvey. That was part 2 of Investing 101. Please stay tuned for part 3 where we're going to try to put it all together. Thank you.